It's gonna take time, whole lot of precious time. It's gonna take patience and time to do it, 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 to do it right, child. I got my mind set on you. 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 And this time I know it's real, the feeling that I feel. I know if I put my mind to it, I know that I really can do it. I got my mind set on you. Set on you. I got my mind set on you. Set on you. But it's gonna take money. Whole lot of spending money. It's gonna take plenty of money to do it right, child. It's gonna take time, whole lot of precious time. It's gonna take patience and time to do it, 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 to do it right. I got my mind set on you. 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 And this time I know it's real, the feelings that I feel. I know if I put my mind to it, I know that I really can do it. But it's gonna take money, a whole lot of spending money. It's gonna take plenty of money to do it right, child. It's gonna take a time, a whole lot of precious time. It's gonna take patience and time to do it, 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 to do it right.
Good morning, everyone, and thank you for joining us for today's event with JP Jenkins on how to exit a private company and achieve liquidity. My name is Megan Sneeman, and I'm the Venture Relations Manager at Stakeholders, where we believe extraordinary businesses deserve exceptional investors. Today, I'm joined by two guests who will be delving into the do's and don'ts, as well as the practical side of exiting a private company. Veronica Oswald and Mason Doik, a very warm welcome to you both. To tell you a little bit more about themselves before we move to our questions for today, I'd like to hand over to them to do a short introduction on who they are and their role at JP Jenkins. Veronica, let's start with you.
Thank you very much, Megan. Thank you very much for having us today. We are really excited about this webinar. My name is Veronica Oswald. I'm the Operations Director of JP Jenkins. I have been at this role since 2017, and it's been a really nice coincidence because I started my career in capital markets in an AIM-listed company. So that kind of taught me about all the pitfalls and challenges of the capital markets in London. And through various spans of my career, it kind of ended up looking at the private markets at JP Jenkins. And I've discovered this whole new world of private companies, venture investing, and I am very much enjoying my time at JP Jenkins. And I'm really delighted we also have Mason with us, and he will obviously do his own introduction, but Yes, we're really excited about growing the team and the company in whole with the whole capital markets.
Thank you, Veronica, and thank you, Megan. And we are, as Veronica did say, very delighted to be here to speak to you all today. So I am Mason Doig, Head of Corporate Development at JP Jenkins. The business itself is doing incredibly well, as Veronica said. We've had a great Q1. My background in history is predominantly in the investment management side, all the way through from portfolio management to private equity and primary. So raising capital for EIS, equity and debt. And I've sort of various years that I've been with investments for maybe a limited time, but still that period, I've seen the real need for liquidity in a private market, and that sort of natural progression pushed me towards JP Jenkins. There's so much capital tied up, and there's 1,000,001 investments, as we'll tell you, the way in which you can go into these inroads, but there's limited way in which you can exit them. So I think the main thing would be to just give you a brief overview of JP Jenkins, if that's okay, Megan. And just give the viewers an understanding of who we are and what we do, if you don't already know us, and our long legacy. So the business, I'm not sure where to start. It's been around since 1991, 31 years. We entered our 4th decade as of this first quarter. The two founders, John Jenkins, late John Jenkins and Paul Brown, founded the business in 1991 with coinciding with the OFX market. So you can actually trace our roots back to the USM, the unlisted securities market. And I think it goes back to even sort of the 1950s, 1960s, is when we sort of began this journey. Luckily enough, we still have Paul Brown with us. He's the head of our dealing and still loves being part of the business and how we've developed and evolved to a more tech-enabled system and gone to the paper-based and old school systems. The way in which we work is the easiest way to understand us, in sort of inverted commas. We are a private stock exchange. So we allow a matched bargain basis trading for buyers and sellers of private companies. So we don't run any wide spreads. There's no market makers running up those prices or running off books. It's indicative price on a set basis. And of course, we have match buyers and match sellers that match that. So we make it as simple as possible for shareholders, investors, and companies alike to trade on the platform. The previous companies we've had on the platform over the last 25 years have been incredible. We've had majority of the Premier League football clubs, even some of the Scottish Premier League clubs. We've had some of the lower tier clubs as well on the platform. It really is that fan-based subscription service that's been built on JP Jenkins over the last 25 years, the likes of Arsenal, Liverpool, Man City, West Ham, Aston Villa, the list goes on, until they got bought out by oligarchs or independent corporates in America, all the way through to NCP, Adnams Brewery, Shepherd, Weetabix, the best of British brands that we all see now on the LSE, the AIM, the junior markets. They all used us as the stepping stone to that listing as well. So that just gives you sort of an overall, a very brief understanding, but me and Veronica will probably touch on it a bit more, how JP Jenkins works and the mechanisms around it. But it sort of gives you an understanding of who we are and what we do.
Brilliant. Thank you so much, Mason. As again, a really warm welcome to both of you, and thank you for your time. As always, anyone attending today can type questions for my guests into the Q&A box at the bottom of your screen, and we will put those to the panelists later on. But let's get started with the questions I have for Veronica and Mason. Veronica, what are the current exit options available to a private company, investor, or shareholder?
Yes, of course. Well, Megan, I think we all know there is so many ways of how you can enter investments and how you can enter into these exciting businesses. We have seen a huge boom in crowdfunding and ways of you can get involved with companies, but the liquidity remains a big question. Typically, you would be looking at MBOs. Alternatively, a lot of companies will still be looking at the IPOs, but because of this access to capital in private markets, these processes are much delayed, especially the IPO. Hence, the secondary markets is also an option for a lot of the private investors and companies that are not at the stage, or they don't feel like they need to be pushed into that early decision where they have to become a public company. And we still love public markets. We still need them to work well. But we're just saying to investors and companies that there are now different options. And with the IPO process being heavily delayed, companies can now afford to stay private for much longer, up to 8-10 years. they can grow and enjoy that growth in an environment which is not as structured. Hence, there are now different options on how an early stage investors could potentially exit companies.
Okay, so can you touch on or expand more on why it's so important to have a secondary market?
Yes, of course. Secondary market can act in a different ways. Obviously, the early stage angel investors or early investors don't always want to sell the whole portion of their holding. They may just want to top slice and diversify for different reasons. They may just want to invest into different companies as well. So really the platform acts as a little bit of a price discovery point as well. And again, it's that shareholder engagement. We very often see private companies that are going through different rounds of financing. And very often the only time they actually go back to their shareholders is when they're fundraising. We don't think that's obviously the most efficient way, and we try and encourage that communication.
Thank you. Mason, would you like to add anything onto that?
Well, I mean, exactly what Veronica said. The biggest problem we find is that most companies come to us and they've done various crowdfunding, private equity funding rounds from various raises all the way through to Series A. And the shareholders say, well, actually, they've only come back to us when they need further capital. And really, it's not just having a secondary, the secondary market is so important, but it's also using that secondary market as a sort of a regular updation tool or a transaction of communication tool for those shareholders. Companies, utilize our platform as a way in which they can provide regular updates. They have glamorous stories, new acquisitions, I don't know, whatever service they may provide. They have new updates on that, and they can push that through our platform, but also to their internal community, which in turn helps them with either the capital raise or the shareholder engagement, or just widening that investor audience. So it's incredibly important to have that there. You see it in the US. If you look at the US as a model, you've got huge companies out there. Examples would be sort of Equity Zen and various other businesses that we've come across and we work with actually quite closely in partnership with. And they've worked out a way in which they can really utilize a secondary market to recycle that capital. So all of this capital that's tied up in VCs, private equity, EIS, SEIS, all these $1 million investment schemes that are great for the economy, can then recycle that capital and pivot that capital back in to further ventures, which of course the UK economy needs right now, given the last 18 months we've had. So that is the main crux of why the secondary market, I believe, is so important.
Okay, now it's really interesting because I obviously see a lot of companies come to me in early stage looking to raise funds, and often the exit strategy is a little bit thin, if you'd like to call it that. Yeah, where the investors, that's a really important part of their decision making. So at what stage should a company really look at their exit? And my second question is planning to enter the secondary market a feasible exit strategy, or a sort of a jump in the exit strategy for founders to present to investors up front?
Well, that's exactly it. As you said, my experience and the limited time I did have within EIS and SEIS capital raising is that one of the first questions any investor will ask, whether they're a shareholder in the company and they're following on from a further funding round, or they are a new investor coming into that community straight away, or from early doors, is what sort of equity or what exit solutions do we have? What liquidity solutions do we have? And there's always that one eye on the exit route, whether they're looking, as Veronica said, on an MBO, whether they're looking on a trade sale, an IPO in 3 years' time, 2 years' time, whichever that may be. And providing a secondary market for them is, in essence, giving them peace of mind that you'd hope as an investor that, or as a founder, that the investors aren't going to all run to the exit door and sell for whatever reason, because of course, if they're EIS, SEIS, they have their tax benefits for 3 to 5 years. But it's more so that there's that peace of mind. They have that liquidity or exit door, whether there's an unfortunate death or some sort of personal circumstance or any requirement for capital, that they have that opportunity and they won't be tied in for 12 years, 15 years, and there's a problem with probate. And we've got sort of probate lawyers calling up saying there's 1,000,001 private shareholders that don't have any access to liquidity and there's no way of selling these shares, or realizing them anyway at a loss. So that's the issue obviously we find as well, which is a whole another bag and kettle of fish on the other side. So to answer your question, it is incredibly important that they have this liquidity solution in place, and they always do have one eye on the exit route. In regards to the feasibility or the costings around the second market and the second question, you look at IPOs, and I think me and Veronica will touch on this further throughout the webinar. IPOs can cost anything from sort of a couple of $100,000 to, I spoke to a company the other day that pays nearly 1.5 million in professional advisory costs. Of course, the reason theirs is higher is the fact that they're actually doing M&A activity, which of course is leveraging a higher cost. But we speak to companies that pay in excess of 300,000 to 1.5 million in professional advisory costs to be on a junior market. And those junior markets do incredibly well. The Aquis, the AIM, the LSE as well, the main market, they do exactly what they say on the tin, and they really help those companies benefit if they're at the right size and it makes commercial sense. But the problem we see is that a lot of companies on the bottom quartile of those junior markets that pay these inordinate fees, and they have these restrictions in place, but they don't see the liquidity. So then it comes to the point at which they actually think, well, there's no really point in being listed. And I think Veronica has even more sort of understanding of this, that a couple of companies that Veronica's dealt with or spoken to have actually gone to look at listing, spent an inordinate amount of fees or incredible costings to actually even look at doing the prospectus fees and corporate advisors and legals and nomads and X, Y, and Z. And then they've come back to us and said, actually, we spent all this money, but we're going to use you guys instead because it's not viable.
Makes sense.
So that's exactly it. I think, the other solutions, obviously there's a trade sale and that's slightly different, or an MBO. But if you're looking at sort of in comparisons to IPOs and the benefit of having a secondary market, we are very cost effective. It works out that probably less than 1/10 of the cost that you'd ever pay to be public. But we're seen more as that stepping stone, more than a comparison, that the companies are at sort of the gap between the size of market cap or valuation size between their listing and between being sort of early stage. And they use us as that stepping stone to help them get to the next step before listing. But it is very cost effective. And Veronica, you've probably got maybe something to touch on there.
Yes, what I actually wanted to say was that, of course, everyone needs to have an eye on the exit. However, the founders are there to run a business. They're not really thinking about selling the business from the day they start fundraising. Obviously, it's a question that they will be asked, so they need to have an answer. But what we're trying to provide them with is an easy solution where they are able to grow in an environment that is not heavily regulated and are able to offer some type of an exit solution to investors that may need to take that option, but they're still allowed to grow and run their business. It's really trying to give them an extra set of tools that we provide them with and really let them run their business, because being a publicly listed company, and especially a small publicly listed company, that was what my first experience with capital markets was, is really onerous. There is a lot of rules that you have to comply with. It costs a lot of money. And when you have a small team, I feel like a lot of the times you kind of lose a little bit of sight of why you're doing it, and you're just running around, complying with all the governance and regulatory things, and it takes away the focus from running the actual business.
Okay, so then in the event that a shareholder wishes to sell, Mason, how can founders then help their shareholders exit some or all of their investments?
Well, that follows on quite nice actually with what we were just discussing in the last question. In the sense that there is an event that a shareholder does want to sell, of course, founders wouldn't actively want to promote all of their shareholders selling these shares, of course. But it really goes back to more of that good communication, good governance point, that the way in which founders can assist those shareholders with accessing that liquidity is, of course, helping with the buy side and the interest of those shares and buying into that company. So using the platform, we always say, is like a gym analogy we use, and our founder chairman use as well, that you can have a gym membership, and you can have that and pay for that per month, but if you don't use that gym membership, you'll never see the benefits and reap the rewards. And that's much like our platform, that companies can sit on the platform, but of course the founders and the board members and the guys within ladies and guys within that business, of course, have to communicate with both their side and our community, and really provide us with the content, regular updates and communication, that we can then build that interest and those shareholders can access that liquidity. So that's sort of a huge point to make, even though the gyms have been shut for the last 18 months and just opened, which doesn't really make sense in the last year or so. Of course, as I said, increasing that appetite communication is huge. Companies, as we've said, Veronica has touched on as well, have to essentially make sure that their filings, accounts are up to date as well, and assist that, because of course new investors want to make sure that everything is up to date on the company's house and the company is correct. Is acting essentially as a public company. It's not that the company has to be forced into doing rigorous reporting standards and regulatory updates, but just that they start to act like a public company and they provide that interest and that regular update to a wider investor audience. Also, we find that nowadays, and with UK law on UK companies, that they have various restrictions in place. So they have drag and tag rights, they have preemption rights in all the companies, they have all these various restriction requirements around different asset classes, shares. And that's exactly why we built our new online platform, because we can be sort of fairly flexible in the way in which we deal with those share classes and asset classes, and that helps those founders with that liquidity. So sort of the direct response to that question is that in our specific example of JP Jenkins, we've got a traditional platform which is broker to broker, settled through the UK CREST, UK settlement system, electronic settlement system, and then we've also got on the flip side our online trading platform Direct. So whichever way suits the company, whether they're looking at a pre-IPO or looking at an IPO in 12 months, or they have their registrar in place, they can utilize that and we can assist them with their ISIN and LEI. Or of course, if it's an early stage business, they think actually we're not looking to list anytime soon, but we can real benefit from the platform itself, and they can help these shareholders access that liquidity, then they can utilize the online trading platform. And those shareholders, as long as the company's passed its DD and signed up and the KYC and AML for the directors, the shareholders can log on and sell their shares through that platform to matched willing buyers and willing sellers. So it's a very efficient and simple process. And it really is using the platform as a shop window. It really, all it comes down to is that shop window, the brand awareness, the benefits of the platform, which build that interest and buy side. And then the founders can say, look, we've got, as an example of a company we've got recently looking at potentially joining us, there's always that interest and buy side already there, and they can easily sell those shares to sellers that come as throughout the years that they need that liquidity.
Okay, so Mason, can you just expand on why liquidity is so difficult to come by in the private marketplace?
It's a very important question, and one that we obviously built our platform on. As I alluded to at the start, so I didn't actually mention, but in the history of JP Jenkins, back in sort of the late 90s, early 2000s, we actually raised £1 billion with the OFX market for UK SMEs. And it's always that old saying that's been heard in webinars over the last year, all the way back to the last decade, that there's 1,000,001 inroads into investments. And there's so many individuals telling you how to invest in companies and what's the best investments to go involved with. But as you said, there's not always the founder's eye or the board's eye on the direct exit or what sort of opportunity they have in terms of liquidity for those shareholders. So firstly, obviously, I think it's brand awareness that a lot of people may sort of in the older generations or grey hair may know of JP Jenkins of past, but it's really that at the current time, a lot of companies and new early stage businesses, scale up startups, may not know that there is a secondary market available for their shareholders and for the wider investor audience as a sort of marketing piece as well. And it really is that, I think it is that boils down to that people don't just know that there is a secondary market solution available. Obviously, you can go through crowdfunding platforms, which are great, and they have sort of various secondary markets inbuilt, but there are obviously restrictions in place. And for early stage angel investors, families and friends that aren't part of that nominee structure, they might require liquidity, and that's exactly where we come into play. I think it's so difficult to find liquidity anyway for founders when they're looking to raise capital, let alone if shareholders are looking to sell those shares, for a secondary sale as well. I think if you look at crowdfunding valuations, they're great for obviously the equity they raise, but they can be fairly subjective as well. And it's very hard to sell those secondary shares if the valuation is sky high and trying to justify that price. So it really is utilizing the platform for price discovery. So if you utilize the JP Jenkins platform the right way, you can utilize that to find a realistic price and realistic valuation where you can see liquidity within the secondary market and within those shares. And it also comes down to obviously that I think it's so difficult to find liquidity in a private market as well, because a lot of investors, especially in EIS and SEIS and EIS, are really focused on the tax breaks. and they're really focused on the benefits of the 3 years, the 5 years, the 30%, the 50%, the capital loss, and all the bits and pieces that come along that, and how much they can offset off the pound. But it really actually is, what's the value in those shares on the secondary side? Because you can actually benefit from, if that company's doing incredibly well and those shares are increasing in price and they've got a secondary market in place, then it's not just the tax benefits that they're holding on to, but once those tax benefits become stale or static after 3 to 5 years, they've then got a liquidity solution that they can then take some capital off the table and go into further ventures moving forward, which is why it's vital for VC funds, PE houses to look at this secondary solution as a way in which they can recycle capital into further ventures that they bring on board. There's only, as I know very well, there's only a finite amount of capital in which investors can actually pull from their pockets for these investments, however good the opportunity is per year. And it really is important to have that capital recycled after 3 to 5 years or 7 years or 8 years back into other ventures.
Okay, thanks, Mason. So, Veronica, you mentioned earlier about IPO and how onerous it can be and underpinned by regulations. Why else would a private company use a private market pre-IPO as opposed to a public market?
Of course, going back to really each point that we have covered, it really is that stepping stone onto the capital markets, where company is starting to behave a little bit more grown up. They really have efficient ways of communicating with their shareholders, and they really do put a little bit of time and effort into recognizing that the shareholders will need to be kept informed and that they will have different types of needs. Secondary markets are very diverse, and they have pretty much existed throughout the history of the capital markets, but they have been very unstructured and are still very unstructured. A lot of companies will try and run their own secondary markets. A lot of PE houses or VCs will also attempt to run secondary markets, but it's all a little bit piecemealed. And what we're looking to provide is really that one-stop shop solution for companies to come in, and it really doesn't matter which stage they are at. If it's a company that's been running for 12 months to 18 months, and they really are going through different rounds of fundraisings, but they would like to provide solution to their shareholders, we would absolutely love to have them. We would most likely start them on the JPJ Direct platform, which is the platform where investors and shareholders can interact directly. And we'll grow them and work with them to eventually put them on our JPJ Traditional, where they will start dealing with brokers, they will start dealing with registrars, their shares are going to be settled in Crest, just like on any of the larger regulated markets. And really, we'll be able to use that expertise we have in-house. And eventually, if their route is to go through an IPO, we can also help them with making sure that they have all the moving parts in place. It's a really bit of a seamless process to guide them from that start when they have really started generating revenue. We have some companies that are a little bit earlier stage, some companies that have been around for a number of years, but because the private markets are working quite well for them, they don't feel there is a huge need to be rushing to that next step. And again, goes back to that point number one that I was making, is really trying to give founders and companies more options. It's all about giving them a way where they can access the liquidity if some of the early stage shareholders or investors need to get it. There is a different ways, so they don't have to be pressured into making decision of going through a hugely expensive IPO if they're not ready for it.
Veronica, you mentioned company stage. What do you have an idea of the most popular stage that companies are in, or when they come for the secondary market and they're ready for that?
It's always the growth stage. It's quite funny. We often get calls from companies which are very early stage, and we would absolutely love to help them, but we kind of do have to tell them, look, it's secondary market. You kind of need to have a little bit of history behind you. So we don't like to say no to companies, because we provide a service to shareholders. We have to be engaged by the company, and this is again purely from the dynamics perspective, where we have to be able to show that we can execute those trades of shares. But we actually work for the shareholders because we are giving them a way in and way out. But yes, it's a very, very different stages. We would say the most typical would be the growth stage, but we have everything from startups to very well-established, mature companies.
It's a great question, Megan. You know, it's one that we get asked by every business that we speak to, or every various company or corporate house we speak to as well. Then, what is the sweet spot, and which company does best on your platform? Of course, there's always a poster story company that does incredibly well. And there's always maybe the companies that don't do so well on the platform every year. The one thing to point out with our platform is that I think it's interesting because some of the companies on our platform purely use it as a quoted price for leverage on acquisition. So they don't actually use it for trading. It's purely the earlier stage businesses that want sort of a quoted price, a price discovery point for their shares. They even use it as a way of incentivizing staff or equity holders or ex-employees or management, that there is a way in which they can sort of log on and see what the value is of their shares, incentivize those new investors as well. But it really depends on the companies. You know, we're sector and size agnostic. As Veronica said, we've got companies on there that've got market caps of 1, 2, 3 million, very early stage, use us as more of a brand awareness and marketing push and to a wider investor audience, which comes part and parcel with the secondaries essentially. And then you've got companies all the way up to sort of 130, 150 million, I think is one of the ones that we're signing on and is being admitted to the platform in a matter of days. So it really is a big varied gap. Of course, it really comes down to the more content they can provide us with and the more updates we can push out, the more interest there is essentially, and the more liquidity there is. It's one of those things that the liquidity can be there, that we can see tens of thousands of pounds trade on a daily basis or every other day on certain companies on the platform. And then, as I said, on the other side, we might have companies that might not trade on a regular basis just due to the fact that they are not looking to trade. They're looking purely as a quoted price point of view. But it is a very important question and one that we get asked a lot.
Okay, great. Thank you. I see some questions are coming through from our audience, so that's fantastic. Just a reminder to our audience to please put your questions into the Q&A panel, and I will be hopping over to those in just a few minutes. The next question, Mason, was about, why it's vital that founders help to find liquidity solutions for their shareholders. I think we've touched on that, but if you'd like to explain a little bit more, that'll be great. But I'd also like to delve into how investors can drive this process with a company if they're looking to enter that secondary market or find that liquidity for themselves.
Sure. So, as you said, we've covered it quite a lot. It overlaps with the reason why in which the secondary market is so important. And the first point we made at the start of the webinar was that we always find from angel investors, angel network groups, investors, maybe sort of even crowdfunding investors that aren't as capital savvy as we may require. Founders and companies do often find there's a problem which they only come back to those investors and shareholders when they require more capital. There's always that saying that sometimes that startups and scale-ups are only 12 months away from another funding round, which always seems to be the case as well. And it is really that it's vital for founders to help, with liquidity solutions, because it's the credibility of the business and it's the reputation of the business. And investors and shareholders are only going to follow on if they believe that they're kept in the regular loop, that they're prioritized within their investment and what the business is doing, and they believe wholeheartedly that company is going to do the right thing. So I think having a secondary market in place, a liquidity solution in place, gives them, as we said, that peace of mind. It's also a massive way in which the companies we normally see statistically can leverage a higher capital raise. So when these companies go out and do another funding round or another raise, if they've done EIS or they're going to go in and do EIS or Series A or whichever it may be, they can normally leverage a higher capital raise because they can say, well, we've got a liquidity solution in place. And the investors say, okay, actually, I'm not going to be waiting 15 years to exit this or pass those shares to my children. So it also allows those angel investors or early backers to have an opportunity to top slice their position or take profits as well. So it does boil down to that engagement, communication, and requirement for liquidity if need be. Not that founders would want their shareholders to sell those shares at a rapid rate, but it's having that solution there in place. And it's not just the trading itself. It's so much more that companies can benefit from. Having that wider investor audience, having that shop window, not having the onerous reporting standards and costs of being on a public market. As more companies come through the ranks at the moment, we're seeing, obviously, there has been a flurry of IPOs that started this year. But if you look at IPOs over the last several years, it's been dropping dramatically. And the amount of companies that delist from those markets is increasing by fourfold as well. So it really is that there is a solution here. And if those companies can benefit from a liquidity solution in the secondary market, there may not be a requirement to list. It just really depends on the company and the board themselves. And answering your second question, in terms of the, it just obviously come to me in terms of the driving that push. We do get a lot of shareholders come to us and say, actually, so the company themselves are not engaged to put in the secondary market, or haven't even thought of it, and don't even know exactly where to go for liquidity solution. But it's normally a lot of the time the shareholders come to us, or even sort of various businesses that are. So we have, through the angel networks that we have, or people that we speak to, that have non-exec directors or chairmen or various strategic business advisors or consultants that are part of these businesses, but also have an invested or equity stake, skin in the game, so to speak. And they say, actually, we're looking at liquidity solution. Can you get in touch with the company on our behalf? So there's normally a large interest that we'll find from a group of investors or shareholders that are looking for that liquidity, which then sort of says that founders and the board, actually, it may be the right time to bring this in place. And as Veronica said, it's normally that companies come to us in their very early stage, and we'd love to help everyone, but sort of pre-seed stage, seed stages, maybe a little bit early for us. That once they've had a number of funding rounds, that they've got a fairly sizable cap table, and that of course they've got pre-existing shareholders, it's not just one founder holding 100% of the equity, then that's exactly when they would utilize our platform, and where we come into play.
Brilliant. Thanks, Mason. I'm going to end off my questions with a golden question to Veronica. How can investors and private companies realize a satisfactory return?
Well, again, so it's all about the communication and trying to encourage the company to be active. But investors themselves have different options. So obviously, just making sure that this is the right time to sell, just really weighing up the pros and cons and thinking how this process is going to be done. It's there's different times to be selling the shares. We've got some companies that have just announced that they're going to complete the route from us and going to list on the public markets. So that is an excellent timing, obviously, because we see a very much an increased liquidity in the stock, and the shares are trading very frequently. So the service we offer is called Match Bargain, which means that we don't go and buy the shares from the individual shareholders and then try and sell them on, but we're actually matching willing buyers and willing sellers. So we have to really try and work quite hard on the liquidity and just make sure that everything is running smoothly. And obviously, when there is a lot of news flow and there is a lot of good news about companies, either generating profit, offering dividend payments, or anything that can really help to give liquidity in the private market, will be obviously the best time to sell. But it's one of those things. We don't participate in financial advice, I must disclose. So we really do act as almost just the exchange. So we just facilitate the transactions. But no, there are different ways how to exit, and obviously it's all about the timing. But really, as we said, we give the company tools to communicate with the shareholders, so the shareholders are kept informed at what stage they are at, and then it's typically the personal circumstances that the shareholders would be facing. But yes, we speak to many shareholders, and both options are a little bit different.
I was going to say, Veronica, just to jump in, apologies. I was just going to say, I think a great example of that in terms of how investors have seen a satisfactory return is one of our poster stories of this year. One of the companies on our platform that joined us over 13 months ago, or it was just under a year, a number of months back. They obviously dropped off for the AIM market, junior market, had to sort of do a bit of restructuring and sort of change in management. And they have now seen their share price and their valuation, their market cap has doubled via the platform. There's been a huge amount of transactional volume between buyers and sellers. As Veronica says, we're matching buyers and sellers on sort of the broker to broker. This is utilizing traditional method as this example occurs. And some companies can do incredibly well, where they actually look at re-intention is to list back on the main market, from doing so well off the JP Jenkins platform and seeing that volume of liquidity. So it really just depends on, as if you can get the communication, the glamorous stories, the sexy news lines that create the interest and the buy side, and the company's going in the right trajectory with the right growth and the regular updates, and of course there's no reason why it shouldn't do incredibly well, and investors can sell out whenever they think suitable.
Thank you. Thanks, Mason. Thanks, Veronica. I'm going to hop over to the questions that have come in from our attendees today. So the first question is an anonymous question. What practical steps can be taken today towards monetizing my investment? And how do I get my private equity investments and ventures to list on JP Jenkins?
Well, we always encourage shareholders to come through directly to us, and we reach out to companies very frequently with the point of saying we are seeing requests from shareholders. We don't often disclose the name. We understand a lot of investors don't want to put that name out there, but we do encourage the company to really start thinking about secondary markets. It's not an expensive option. Again, as Mason said, it really is probably 1/10 of the smallest.
Less than that, yeah.
So our fees are very reasonable. We charge the company from £10,000 for the whole year of trading. So it's really an easy entry point for the companies to have a facility. So we really do encourage any shareholders to come through to us, so we will reach out to the company.
Well, that's exactly my role in terms of head of corporate development and the team below me as well. So in terms of that, we have regular shareholders, investors, whether it be PE houses, VC funds, crowdfunding platforms, and they have various company investments and investments in their portfolio that they wish to maybe realize a return or access some sort of liquidity, or even if it's at a loss. In that case as well, and what they will do is they will reach out to us, as Veronica said. Most cases they won't want to disclose their name or sort of cause any issues or friction with the founders of the board themselves, but then we'll be more than happy to reach out with those companies, engage with them and make sort of clear that there are maybe potential shareholders or even buy side, there might be sort of investors that are interested from our community on those companies if they wish to join the platform, or if they so did go through with actually the admission process. And then obviously it's then down to us that we would obviously present that opportunity to those companies. We do sort of regular demos on a weekly basis, as Veronica and me have become very used to doing Zoom demos of the platform and how the trading works and running that through, and really giving the company the insight of what the benefits are for not just the shareholders and the investors, but also the companies as well, and why there is that huge requirement there.
Thank you. So linked to that, another question came in: what are the costs to feature my company on the JP Jenkins platform? Yeah. Veronica, you mentioned £10,000 to trade for a year. How long do the companies generally then stay on the platform and trade for?
Sure. Again, very varied. It depends on the circumstances of the company. If the company is quite early stage, they will typically stay with us for a bit longer. We've got some companies that are never planning to go public, and they just want to use us for that price quotation. But it really depends. Sometimes companies come off the AIM market and want to do a bit of a restructuring. As you know, trying to restructure a company in the public markets is excessively expensive. So they will most likely come off, do a little bit of restructuring, and then list back onto the public markets. So there is really different ways. But going back to the price points, we are completely transparent. So all our prices are on the website. Our prices start from £10,000 annually for the company, and range up to £30,000 for much larger entities. So we try and keep that price point very low to encourage that secondary market.
So it runs on essentially a scaling basis of market cap or valuation. So typically, obviously, most companies on the platform and companies that we speak to that are being admitted in the next sort of Q2, Q3, Q4 do fit into that 10,000 bracket. It's only if the company's obviously of a much greater, i.e. the company that's joining at the moment is over 150 million market cap, then obviously they pay maybe a little bit more. But that cost includes everything from the initial admission statements, the due diligence that we do internally and externally from a third party, also through to obviously the post-trade transactions, updating company's house, and of course acting as registrar for the company as well. So you think that in turn, when I speak to companies, they pay anything between 3,000 to 12,000 or more for a registrar purely to act on their behalf, to manage that cap table. And we actually take that on board as well if a company utilizes our direct online trading platform. So it can be incredibly cost effective for them. And as Veronica said, it starts from that price point.
Thank you. Now, a question's come in. I noticed that there are a number of PLCs trading their stock on your platform. Why would they do that rather than through the stock markets they're listed on?
Again, price points and liquidity. As Mason mentioned, the liquidity in public markets and junior markets, when you kind of in the lower quarter of the whole segment, is pretty limited. There isn't that much liquidity, but you still have to pay those enormous fees for your nomads, brokers. Just, you know, maintaining the listing costs hundreds of thousands of pounds annually. So it really is trying to weigh up the pros and cons of the public markets. Again, as we said, we are still campaigners for the public markets. We do need them to work efficiently. We're just saying that there is time and point for the companies when they think they do need to take that next leap.
Once they get to sort of size and scale and it's economically viable for them to be listed, that it makes sense. Whereas the problem was over the last decade, a lot of companies, or even more so further back, that a lot of companies were jumping onto an IPO or a junior market, believing that was sort of the best route, which it can be, of course, for various companies, and they can do incredibly well. But you then see that a lot of companies, I can't remember actually exactly what the figures were, Veronica, but I think it was either a couple of hundred companies to maybe 700 companies, I think, were sat at the bottom of the junior markets with a market cap of between sort of 1 and 10 million. And they saw hardly any liquidity whatsoever, but they're all paying in excess of 100 to 300,000 listing fees. Obviously, there are other benefits than just the liquidity itself of being listed on a public exchange. But it really is dependent on that company themselves, whether they want to do sort of some buybacks, whether they want to restructure the business. Being on our platform, we don't have a great macroeconomic effect. So as you can see at the moment, obviously the market's a bit tumultuous. I've personally seen myself that, you know, that it's been up and down over the last couple of weeks, which has been a bit of an issue. But with our platform itself, there isn't a huge effect on those share prices. Obviously, they're all set at indicative prices, and there's not a macroeconomic effect on that. You know, if a board member or a founder or a director says, actually, I'd like to realize some paper wealth or return on my paper wealth after 10 years of running a successful business, I can actually sell those shares on the JP Jenkins platform and not get sort of hung up and drawn and quartered by all the shareholders. Because if you know, a founder or a director or a board member sells their shares in the public market, you normally see a drop in the share price. And most times they're actually just looking to actually realize a little return for a lot of hard work. So that's obviously what some investors or some board members have used our platform for as well, to sell a very, very small portion of shares to actually maybe realize a little return after a lot of years of early graft.
Is your platform digitally linked to Companies House?
No, we're not digitally linked to Companies House. So the updates actually still have to be manual. We do need to get the approval from the company that, yes, we are allowed to submit all of those shareholder and cap table changes. We're not digitally linked. We, to be honest, didn't really see the need for it at the moment. We do actually work with someone who we have a joint venture agreement that can do that for us. But at the moment, it seems to be working quite well. But it is a possibility for us in the future that we might exercise that option.
Okay, thank you. Another question then, as a private investor, how can I join the platform with a view to acquire shares in a company?
I'll leave that to you, Mason.
Yeah, no, of course. So if you're looking at, so on the marketplace, you'll find, as most of the individuals on the webinar may have seen, investors, shareholders, angels, founders, whoever you may be. If you're looking at the marketplace and that main page where we have essentially sort of it looks similar to sort of a stock exchange market essentially, and it has the financial figures there. Each company is differentiated between traditional and direct. So the two trading platforms, as we mentioned. If you're looking at buying and selling shares on the traditional platform, that is purely broker to broker. So if you have a broker in place, then of course you can purely instruct that broker incredibly easily. If you've already got someone in place to get in touch with us and to buy those shares or to place a buy order with our dealing desk, and that broker can get in touch with our dealing desk and place that buy order, and that'll be matched with a willing seller essentially on the other side. If of course you're looking to buy shares on our online trading platform, there is a link through on various pages on our website, and that's at the footer of the website as well, that you can actually click on to take you through to our online trading platform direct, and that's where you can sign on as an investor. So there you can sign up as an investor or register as an investor. You verify your account. It's a very easy one page. I think most of you will be fairly familiar with a KYC form that you've probably filled out over millions of them over the years. You fill in a simple form. It self-certifies that you're, a qualified investor or sophisticated investor. And of course, once you're verified, then you can buy those shares. You can obviously deposit capital into your account. You can see that in your account. It's held as our custodian. And then, of course, you can buy those shares and see them held on that. And we can update, of course, the share registrars, and the share certificates are digitally sent as well in turn in lieu as well. So it's very simple. If it's the broker to broker method, it's purely contacting your broker. If you don't have a broker, it's not an issue at all. We have various brokers throughout the city that we recommend and we've worked with for years that can do that very cost effectively. Or of course, you've got the online trading platform that you can self-certify for and sign up yourself and do that trade yourself.
Thank you. Two more questions here. So if a company's shares are available via secondary market, won't that depress the valuation and share price for the company in a funding round? For example, new shareholders would be better to buy the shares from the secondary market rather than take up the new shares in the round.
Mm-hmm. Yes, really, really good point. And yes, typically the secondary markets would have been operating on a discount level. However, again, going back to that US model, we actually see a lot of the times the companies are trading at a premium purely because they haven't had a fundraising round and the business has been doing very well. So obviously there would have been an uptick already. But yes, so we see a little bit of both. We sometimes see shares trading at a discount, and sometimes we see shares trading at a premium. There is a way of protecting that price. Typically, if companies fundraising is doing a primary raise, we will hold the trading and we will let the company go through the fundraising. Once the fundraising has finished, they will obviously have to give us the documentation so we can check, and we will update the share price on our platform so everything stays consistent. But we do use that hold option quite frequently with companies that are fundraising.
Yeah. Typically, if a company is looking to raise, which they do over a year, 2 years, 3 years, then
they do that.
We can put that whole function in place, so there isn't that price disparity or arbitrage between the two prices, and then obviously it's regularly updated after that, as that's completed or finished.
Thank you. And then the final question that's come through: how do you prepare these companies for the secondary market? For example, sorting out their financial accounts, due diligence, etc.
Yes, it's again, it depends on the stage of the company, but quite often companies are actually very well organized, I must say. Even companies that are early stage, they already have the accounts, they already have the cap table, so it's not too onerous for them to maybe just say, look, let's just maybe adjust a little bit of the stuff in the pitch deck. Let's maybe do a few more announcements on what is happening with the team. So it's really more of a guidance rather than telling them, look, let's do this, we need to do that, or you have to do this. We try and work with the companies to make it, this is an ongoing relationship, as Mason said. It's not just coming to the platform and forgetting about it. The companies need to realize that this is going to be a little bit of a working process. They will need to give us enough ammunition to send out there, and we will work with them whichever way is necessary. If we feel that they are lacking in the governance part, we have different advisors that we can recommend them. If they're looking for extra funding, of course, we have partners like stakeholders that we would then point them to. It really depends on what the company is lacking at, but we do have a structure that is called the second market that we have built specifically to help these private companies with those missing parts, whether that is a little bit of a PR, IR, structuring, governance. We have advisors that we work with, and we know that they will be suitable for private companies. It is a tricky world out there when you're a private company and you're looking for the right advice, because obviously everyone knows those big names of big accountants or big advisors, but they're often extremely expensive. So we do have an ecosystem of parties that will be able to cater to those companies that are just scaling up or are on that trajectory route up, and we'll be able to give them the correct advice.
Okay. Thank you. I'd like to run a quick poll for our investors on the line, and it's really helpful to us as a team to understand what kind of investors you are, how you like to invest, so that we can make sure we put the right events and the right companies in front of you. So there should be a poll on your screen now, a few questions. What is your typical investment amount into one business? And you've got some options there. What is your preferred method of investing? Via a regulated platform, directly with the founder, or via an SPV? Do you know a business currently seeking funding you would like to refer to stakeholders? And I will be in touch with you to get those contact details. And are you looking for an exit from any of your investments? Yes or no? I'm going to leave that poll open for another 20 seconds just for everyone to cast their votes. It really does help us. It gives us incredible insight into who's on the line, and into always making sure we deliver to what our audience wants to see. There's still a lot of votes coming in, so thank you. I'm going to leave that open still. Okay, I think we can close that down now, Helen. Thank you. Well, thank you once again to Veronica and to Mason for joining me today and for answering all my questions and the questions we had from the audience. It was excellent chatting to you and getting such valuable insight into that secondary market and exits and liquidity. So really, thank you so much for your time.
Thank you for having us. It was a real pleasure. Thank you.
And if there's any other questions from any of the viewers or other individuals that get in touch, feel free to get in touch with us. And we're more than happy to sort of have further follow-on calls and sort of explain it a bit further if it was a quick run over today that didn't sort of cover everything.
Absolutely. Thank you. And if any of our investors online do want to be connected to Veronica or Mason via us, please just send us an email and we'll be more than happy to make that introduction and connection. To help with the feedback on this event, please do take the survey that will pop up on your screen at the end of this webinar. We have 4 more exciting events lined up for May, ranging from a Feet to the Fire session with the CEO of SaaS platform My Customer Lens, delving deeper into their business, to our FinTech Powerhouse event with some of the leading figures in FinTech at the table. Details on these and other events will be sent in our follow-up email. Now, my quote to end today, in fact, Mason, comes from one of the articles you wrote on LinkedIn. I found it there from The Social Network in 2010. $1 million isn't cool. You know what's cool? $1 billion. Have a great day, and I hope we see you again soon. Bye.
Yes, thank you.